You got to become very, very cheap. Hey, George. I don't think I can come with you to the Gucci store anymore. Jaspreet's yelling at me again. Cut out everything that you do not need to survive until you have those $2,000 saved up.
Oh, I hate you so much, Jaspreet.
You hate me now, but you will thank me later. I was reading an article the other day that said that nearly half of all Americans die broke. Now, some people will hear that and say, oh, that's great. You had enough money, just enough money to live through your life, and then you died with zero. But that's not really how it works. It was people that didn't know what to do with their money. They lived broke, they retired broke, they weren't able to live their life financially free, and so then they died broke. If you do not want to die broke, if you don't want to live broke, you need to understand some of the money myths out there that are keeping you broke. And in this video, that's what we're going to be going over. So let's jump right into it. Have you heard of the 50-30-20 rule of money? The traditional 50-30-20 rule looks like this. You take your after-tax income and then you turn it into an oddly shaped pie chart, and then you take 50% of your income, and that's the money that you should spend on needs. So this is things like food and a place to live. And then you take 30% of your income, and this is the money you should spend on wants. So this is things like designer clothes and partying, things that you don't need but you do want. And then you take your extra money, your 20% that's left, and you should save that money. I consider myself to be a fairly nice person. I hope you do. But when it comes to budgeting plans that are so horrible, like the one that I just showed you, I turn into not so nice Jaspreet. And nobody likes not so nice Jaspreet. First, while that 50-30-20 plan looks harmless at first glance, it doesn't incorporate any investing, minus the fact that you are allowed to use your savings to pay down your debt. Apparently, under this budgeting plan, the financially smart thing to do with your extra cash is save it. Do you remember that story about that really rich person who became rich by saving all their money? Oh, you don't? Maybe it's because nobody ever became wealthy by saving their money. If you want the brutal, honest truth, saving is actually making you poorer because inflation is eating away at your savings. Right now, the average savings account in America pays an interest rate of 0.09%. And at the same time, inflation is 3%. Which one is bigger? Your savings account, which pays you 0.09%, or inflation, which is 3%? Looks like somebody got triggered. Let's say that today you have $1 and you're thinking about buying this pack of gum, which also costs $1. You can afford the pack of gum, but you're like, you know what? I'm gonna do the financially smart thing and I'm gonna save my money. So you take your dollar and you go to the bank and you save your $1 in the bank. After 1 year, what happens? Your $1 will grow, which is a good thing. Your dollar will grow to just under $1.01. Remember, interest rates in your bank are on average 0.09%. So your $1 in the bank grew to $1.01. A little bit less than that, but let's just say $1.01. At the same time, inflation is 3% a year. That means on average, if a pack of gum costs $1 today, after 1 year, it will grow to $1.03. So you could afford that pack of gum today because you had $1 and the gum cost $1, but after 1 year, your dollar only grew to $1.01 while the pack of gum grew to $1.03. You just became poorer by saving your money. Trigger, trigger, trigger. But the horribleness of this 50-30-20 rule doesn't end there. I mean, this rule is actually encouraging people to spend more on luxuries even if you don't want to. This rule tells you that you should be spending 50% of your income on needs and you should be spending 30% of your income on wants. So if right now you are spending 15% of your income on wants and you're happy, you're not spending enough on luxuries. So you should go out and buy more designer clothes and buy more vacations, even if you don't necessarily want to, because this budget says that you should spend more money on wants. Wait, who's gonna actually spend more money on things they don't need because of a budget? What are you talking about, Jaspreet? Think of it like this. let's say your boss gave you a $100 weekly allowance to buy things for your office. And you're not incentivized not to spend the $100. So you go to the store and you could buy everything you need for just $25, but because you have $100 and because you're not incentivized not to spend all $100, what are you gonna do? You're gonna buy the nicer toilet paper, and you're gonna buy the nicer pens, and you're gonna buy the nicer paper because that's the money that you're given to spend. And I thought that I liked when people made budgets. The reason that I found out about this 50-30-20 rule is because I actually have my own 50-30-20 rule, and some of my students have told me that they thought that my 50-30-20 rule was gonna be this. My 50-30-20 rule applies to people who are younger or who don't have a lot of financial responsibilities, and the way it looks is like this. You take your after-tax income, and instead of making a oddly shaped pie chart, you are gonna make a dollar sign that looks like this. So you take 50% of your income, and this is all that you're allowed to spend. So this is your wants, needs, whatever. You get to decide how you want to spend it. Then 30% of your income is what you will invest, and 20% of your income is what you save until you have 6 months of expenses saved, because saving is losing. So you want to have an emergency fund or a savings fund, and so once you have 6 months of expenses saved, you don't want to save another penny, then you start investing that extra money. If you are older and you have other financial responsibilities, chances are you can't live off of just half of what you make right now, so you will follow our 75-15-10 plan, which says you should spend a maximum of 75% of what you make, and then you will invest a minimum of 15% of every dollar you make, and then you will save a minimum of 10% of every dollar you make, with the same disclaimer as before. Once you save 6 months worth of expenses, you will not save another penny. You will start investing that other money. This way you can create more income. Let me tell you why I prefer my 75-15-10 and my 50-30-20 rule over the traditional 50-30-20 rule. Besides the fact that these are my rules, of course. First, the end goal with my rules are to help you thrive, not just survive. Our plans are centered around you creating more income, which is why you should be investing more than you save. This way you can earn more money. And when you earn more money, you will invest more because you're gonna follow the same percentages, 50-30-20 or 75-15-10, but you will also have more money to spend and live a better life and build your wealth at the same time. Second, the spending numbers of spending 50% or spending 75% of your income are maximums, not requirements. If you live off of 75% of $50,000 right now, and then you work to earn more money, like you invest in your business and you invest in other income producing investment seeds, and you start creating more income, and now you start earning $500,000 a year, you aren't required to still live off of 75% of your income. Like, if you can live comfortably off of 50% of what you make, hey, you can invest the other 50% and create more income streams. My plan doesn't tell you that you need to spend 50% of your income on needs and 30% of your income on wants. You are given a maximum. You should spend a maximum of 75% or 50% of your income, depending on which plan you follow, and you are given a minimum for how much you invest. You should be investing a minimum of 15% or 30% of your income, depending on which plan you follow. This way you can create more income. And if you're thinking, oh, Jaspreet, well, if you get to that type of income and that type of wealth, well, you'll know that you don't have to spend 30% of your income on wants, and you don't have to spend 50% of your income on needs if you don't want to. Yes, you are 100% right. And do you want to know why you will know that you don't have to spend 30% of your income on wants and 50% of your income on needs? Because you will never become wealthy by following that type of traditional 50-30-20 plan. That old 50-30-20 model that I've been talking about is built to help you survive. But if you want to thrive, then you need to follow a plan that will help you actually build your wealth. And if you want to learn more about how to budget your money smartly and how to allocate your money and build a financial system, I made a YouTube video on this, and I'll link it in the description below for you to watch. We're going to jump back into the video in just a second, but before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who have been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now, the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, then Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now, if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well, then you can stay. And if you decide to stay, it's not gonna cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you wanna try it out, I'll put the link to how you can learn more and join Market Insiders with a free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you wanna learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. You might think that you're the one driving your car, but in reality, for a lot of Americans, your car is the one driving you. I want to start by going over the real cost of your car. So the average new car payment in America is $554 a month. This is how much people are paying for a new car right now in America, and the average lease payment for a car is $487 a month. So I want to be conservative, so I'm going to do all the examples assuming we go with this lower amount. This $487 a month for a car. So you have the average person in America making something like a $487 monthly payment on their car, which will get you something like a $27,000 car. But the interesting thing about this car payment is your car is a triple threat. You are paying interest on a car which you have to pay to maintain every single year, which depreciates in value. What that means is, yeah, you bought this car as a $27,000 car today, but when it comes time for you to sell this car, you're not gonna get anywhere near $27,000. Cars are liabilities. What that means is the longer you own it and the more you drive it, the less your car is gonna be worth. You can compare that to something like a stock or a house, which are assets, where in general, the longer you own this thing, the more it's gonna be worth. Cars, on the other hand, just take money out of your pocket every single month because you have to pay interest, you have to keep paying money to maintain it, and this car is losing value every single day. So you're paying $487 a month and you're getting a car with a heated steering wheel. That's pretty cool. But if you took that same $487 a month and you invested this money into, let's say, a low-cost index fund that was paying a 7% annual return. So this is not something super aggressive. We're talking about an average 7% return a year. After 5 years, this $487 monthly investment at the 7% return would grow to $36,000, while the value of your car would come down to $11,000. So after 5 years, this is what your money would look like. Your investment would have been $36,000, but you wanted a heated steering wheel, and so your car is only worth $11,000. So this is what you get if you invest your money, and this is what you get when you want heated seats. Now, let's keep going with this. Let's say you do this for 10 years. So after 10 years, your investments won't be worth $36,000. They'd be worth about $87,000, assuming you get the same return. And your car and your heated steering wheel would be worth about $4.5 thousand. If you do this for 40 years, now, so 40 years, your investments would be worth over $1.2 million, and your car would be worthless. And by this time, who knows what's gonna be out? Heated steering wheels might not be a thing then. You might have some chip in your hands that keep your hands warm. If you have $500 to put towards your heated steering wheel every single month, but you don't have $500 to put towards your investments, something is wrong. And at this point, you're probably thinking, but Jaspreet, how am I supposed to get to and from work? Hold that thought. I'm gonna get to that in just a minute. But when we posted this concept on Instagram, where we said if you invest $400 a month and get a 7% return, you will be a millionaire in 40 years, we got two kinds of responses. The first kinds of people said, oh, I don't want to wait until I'm 40 years old to become a millionaire. And the second people said, where am I supposed to invest an extra $400 a month, Jaspreet? Let me start by answering the first part. But before I do that, I need you to do me a quick favor and smash that thumbs up button below, because at this point, a lot of people are getting triggered and probably smashing that thumbs down button. So if you want to help balance that out, help me by smashing that thumbs up button below. If you're given two choices, you can either be a millionaire today, or you can be a millionaire when you're 70. I would pick being a millionaire today. Who wouldn't? But the problem is the majority of people are broke today, and they're going to continue to be broke or just above broke when they're 70. Baby boomers are in their mid-50s and mid-70s right now, and many baby boomers do not have any money saved for retirement. And if they do have money, it's nowhere near what they need to retire and live financially free, or even something remotely close to financially free. So yeah, maybe you don't want to wait 40 years to be a millionaire, but in my opinion, now I know, I'm just a random guy on YouTube, so what do I know? But in my opinion, I would rather be broke now and rich later, instead of broke now and broke later. If I can't be a millionaire tomorrow, I'd rather be broke forever. By the way, if you're really concerned about waiting 40 years to build this type of wealth, you don't have to wait 40 years. There's other things you can do, and I'm gonna be talking about that in just a minute. Second, people kept talking about how they didn't have $400 to invest in building wealth in their future. Yet, you have $400 to invest into a heated steering wheel every single month, which is a money trap, which is keeping you broke, which is keeping you from becoming wealthy. And actually, the average person is paying a whole lot more than $400 a month, especially when you start adding in upgrades and premium gas and insurance. You're already spending this money. The issue is right now, this money is going into somebody else's pocket and it's making somebody else rich. It is not making you rich. So what I want you to do right now is shift where this money is going and put it into your own pockets. That way you can make yourself rich first. That way you can buy your dream car and not worry about the price. Okay, Jaspreet, but then how am I supposed to get to work? If you're subscribed to our YouTube channel, you know that I love nice cars. And if you're not subscribed to our YouTube channel, you should probably do that. But what you might not know about me is that for the last decade or so, I have been driving the same beat up 2007 Toyota with like 170,000 miles on it. The car might be worth $1,000 on a good day, but it drives just fine. There's no issues with the car. I mean, it has dents and scratches, and I got 2 different rims on the car, but it takes me everywhere I gotta go, and it's safe, and it's saving me a whole lot of money. I can afford to drive a much nicer car. I'm not saying this to brag, but I make good money. I mean, tomorrow morning, I could go to the car dealership and buy a nice supercar, pay them 6 figures in cash, and it wouldn't affect me a bit. And you know what? I will be driving a nicer car one day, maybe even soon. I like nice cars. But I chose not to spend that money over the last decade because all the money that I haven't been spending on my car has been going towards my investments and growing to build my business. I understand that my car is a money trap. If I took $200,000 and I bought a nice car tomorrow, I would look really sweet and I would have a nice car. But the $200,000 that I spend on my car is going to be worthless in 40 years, and it's actually going to be worthless closer to 10 years if it's a supercar. But if I invested this money in my business or an investment, I know that I can build wealth with it. Look, I understand that I'm young and I have the power of time on my hands, which is why all of my focus is on building, not looking sweet. and as I get older, I'm gonna start shifting it a little bit. When you build your pie bigger, you can take out a smaller chunk and live a whole lot nicer. If you're worth $10 million and you take out just 1% of it to drive a car, you're gonna drive a much bigger car than if you're worth $100,000 and you took out 10% of that to buy yourself a car. Most people are not gonna understand this. That's why I call it the minority mindset, because we think different than the majority of people. Most of my friends are always joking around about my car, but the numbers speak for themselves. Car companies spend $35 billion a year to sell you the idea that if you drive a nice car, you're gonna have a great life, you're gonna have an awesome family, and your neighbors are gonna be jealous of you. But what they don't tell you is the real cost of your car, because the cost of your car isn't just $400 or $500 a month. The real cost of your car is your future wealth. I'm not saying don't own a car or don't drive a nice car. I want you to drive a supercar. I want you to drive that luxury car. I want you to drive something nice, but I want you to be able to afford it first. That way you don't gotta worry about the price, and that way you're not sacrificing your future freedom. You need a car. I get it. What I'm saying is, do you really need a car that's costing you $400 or $500 a month? What I'd rather have you do is go out and buy a used but good working condition car with cash. That way you don't gotta worry about the monthly payments, and now you got a car that takes you from where you gotta go, and you got the extra cash in your pocket that can build your wealth. Leasing is almost never the smart financial decision, so leasing should be completely out of the question unless you are worth at least $1 million. Financing is never the smart financial decision when it comes to buying a car, because when you finance, you're paying interest to own a depreciating liability. Cars don't make money, they lose you money. And if you have to pay interest to buy something that is losing your money, you're losing money twice. You're losing money in the value of the liability because the car value is going down, and you're losing money by paying interest to own something that is losing you money. Buy used, use your extra cash to build wealth, and now when you have this wealth, go out and buy whatever car you want. It doesn't matter, because now you can afford it and the price doesn't even matter to you. Earlier in this video, I talked about how you can build this wealth faster than waiting 40 years to do that. You can either invest more aggressively, that means put in more than $487 a month, or you can grow your money faster. If we're talking about investing more money, then you can either cut more expenses, that way you have more money to spend, or you can raise your income. That could mean looking for a new job or asking for a raise or getting a promotion. If you have more money, then you could put more money towards the investments. That way you can build your wealth faster. Or the alternative is growing your money faster than 7% a year. I said this 7% a year because this is a completely passive investment. If you went out and you threw your money into a low-cost index fund, which is a fund that gives you exposure to the stock market, now, you're not doing anything. You're just throwing your money into this fund and you're letting the stock market do its thing. This is where people say, oh, where are you ever gonna see a consistent 7% return on your money every single year? And yeah, you're right. You might not see a 7% return every single year. One year you might see 4%, one year you might see 5%, one year you might see negative 2%, but other years you might see 8%, 9%, 10%. And so over the long run, this is what we've seen on average in the stock market. If you want to beat the 7% return, it's very possible, but it's not going to be as passive. This is a passive investment where you're just throwing your money into something and then you're walking away and you don't do anything and you just let your money grow. If you now invest your time along with your money, you can grow your money a whole lot faster. There's a few different ways you can do that to get the better returns. One way is to be more active in the market. So now you're trying to find growth companies and you're actively trading them. That way you can get a better return. It comes with more risk, but it also comes with the opportunity to make a better return. Or the alternative to that is you can start your own side hustle, because now you're investing your money and your time into this thing, the side hustle, that can grow way faster than 7% a year. If you took $1,000 and you went out and you started a side hustle, the side business, there's a chance that you can make the $1,000 back within 6 months. That's way better than a 7% return. And if you continue to grow it, that $1,000 investment that you put into your side hustle could become a $1,000 a month return, or it could be a $1,000 a week return. That is way higher than a 7% annual return with a passive investment. Now again, starting your own side hustle, starting your own business comes with risk and you can fail. But if you really want to amplify your wealth, there's only two ways to do it. You can either grow your money faster or invest more money. If you want to invest more money, you need to have more money. And if you want to grow your money faster, you got to take more calculated risks. Everybody says they want to be wealthy with their mouths, but the real question is, how bad do you want it? What are you willing to do to make it happen? If you're not willing to take the risks or make the sacrifices, I'm sorry, it's never going to happen. Buying a home is not always the right answer. I mean, sometimes it's cheaper for you to rent than buy, and sometimes it's less stressful for you to rent than buy, and sometimes it's more flexible for you to rent than buy. Buying a home is a big decision, so you want want to make sure you're ready to buy a home. But in this video, I want to talk about the reasons why you should not buy a home. The first reason why you should not be buying a home is if you do not have enough money saved up in your bank account. And when I talk about your savings, I'm not talking about your down payment. I'm talking about actual savings in reserves in your savings account in cash. That way, if something were to happen, you have money to fall back on. Now, typically, you want to have at least 3 months worth of expenses saved in your bank account. So if you're spending $5,000 a month, you want to have at least $15,000 a month extra in your savings account before you even consider being a homeowner. I used to be a real estate salesperson and I'm a real estate investor. And one thing about homes is things break. And when things break, when you're the homeowner, you have to pay for it. I live in a northern home where it gets cold and it falls below freezing during the wintertime. And one of the things about the cold winters is you can see the pipes, the plumbing pipes burst because of the cold. That's exactly what happened to a rental property of mine last year. I had a home where a tenant was living and everything was fine. They had the heat on, but it was so cold that underneath the house, under the crawl space, the pipes froze and they actually burst. This was an unexpected expense. Luckily, we were able to get the water turned off quickly because the water was spraying everywhere, but it cost us thousands of dollars to fix the damage and to fix the plumbing and to put in new insulation. That way this doesn't happen again. When you're a homeowner, you have to be prepared because pipes burst, they clog, windows break, ACs bust, and furnaces go out. And when that happens, you need the cash to fall back on. And if you don't have any savings, then you're gonna have to go into debt in order to fund these repairs just because you wanted to be a homeowner. Now you're paying interest to fix your window. Before you go out and start thinking about buying a home, I need you to first save some money. That way you can afford these emergencies when they come your way. The second reason why you should not buy a home is if you cannot afford, keyword afford, the down payment. So this point is not gonna make my realtor friends or my banker friends very happy because there's a difference between being able to afford your down payment and just being able to make your down payment. If you go to a real estate agent and you tell them that you want to buy a home, they're going to try to find you the best home possible. Typically, the best home possible is also the biggest home possible, and coincidentally, the biggest home possible also gives your real estate agent the biggest check possible. So your real estate agent is in the business of trying to get you a home. Your banker's job is trying to get you finance for the home. So your banker, also like your real estate agent, does not get paid unless you actually buy the home. So your banker's going to try to do everything they can to get you a mortgage to buy a home, even if you can't necessarily afford the down payment, because the bank has a very different definition of what it means to be able to afford a down payment. Your bank's goal is to become wealthy. It's not for you to become wealthy, it's for the bank to become wealthy. And the way the banks get rich is by lending you money and having you pay interest on this money for the rest of your life. So the bank is gonna try to do whatever they can to give you a loan, even if that's not necessarily the best thing for you. And your real estate agent's job is not to look out for your financial health. Your real estate agent's job is to find you a home and sell you that home. Your job is to be the one looking out for your wallet. And what a lot of people do is they rely on their real estate agent or they rely on their bank to tell them what they can afford. This is a big mistake. We saw this happen to an extreme during the 2008 crash because back then, if you wanted to buy a home, you could qualify for a ninja home. Ninja stood for no income, no job, no assets. So if you didn't have a job and you didn't have an income stream and you didn't own anything to your name, you could still qualify for a mortgage. All you had to do was go into a bank and tell them that you wanted to get a mortgage, and they'd say, great, how much money do you want? So you tell them, I want $300,000. And they tell you, no problem. We will give you that $300,000. That way you don't have to put any money down. So no down payment required. And if you sign the papers today, we'll also give you a free TV. Nowadays, you can't walk into a bank and walk out with a $300,000 mortgage without showing your income or a job. However, banks are still gonna try to do whatever they can to help you get a mortgage, even if you can't necessarily afford it. If you wanna be able to afford your down payment, you need to be putting down 20% of the home's value as the down payment. Now, I know what you're thinking. 20%? That's a lot of money. If I wanna buy a $300,000 home, that's $60,000. Yeah, I know, 20% is a lot of money, but if you want to be able to afford the down payment, then you got to be putting down 20%. If you don't put down 20%, then the bank is going to hit you with extra fees and higher interest rates and PMI just because you don't have enough money to afford a 20% down payment. If you're not able to put down 20%, then the bank is going to look at you like a riskier investment, because when the bank loans out money, it's an investment. And so they look at your credit score and they look at how much money you put down, and then they rate you as an investment. Are you a safe investment or a risky investment? If you're a risky investment, that means you're not putting down 20%, then the bank has to make up for the higher risk by charging you higher fees, like a higher interest rate. So now, if you don't have 20%, you're gonna have to pay more money in interest just because you didn't have enough cash to afford this 20% down payment. And the bank is also going to charge you something called PMI. PMI stands for private mortgage insurance. And essentially what it says is because you don't have 20% down, you don't have as much skin in the game, so you're more likely to walk away from your home. And if you walk away from your home, now the bank is going to have to foreclose on you and they're going to lose money. And so when you pay this PMI, you're buying insurance, not for yourself, but for the bank. So you're paying for the bank's insurance. That way, if you do walk away from the home, the bank is protected because now they have insurance that you're paying for. If you don't put down 20%, you're buying the bank's insurance. But you can avoid paying that extra fee if you just put down 20%. So when you have enough money to afford the down payment, now you can avoid paying PMI, you can avoid paying the higher interest rates, and you also have more equity in your home. Going along with not being able to afford your down payment, you also want to make sure that you can afford your mortgage payments, your monthly payments, because like I said before, just because you can make your mortgage payment doesn't mean that you can afford it. Back when I was a real estate agent, you'd hear people talk about the 33% rule, which essentially said that you want your mortgage payment to be less than a third of your gross income before taxes. Nowadays, you hear banks talking about the 28% rule, which says you take your monthly gross income, so before taxes, and you take 28% of that. That's how much your mortgage payment should be. But this 28% rule doesn't take into factor your property taxes and insurance. So when you add it all up, it ends up being about a third of your income before taxes. So I guess things haven't really changed. So let's take a look at the numbers. Let's assume that you make $5,000 a month before taxes, and a third of your income, 33% of your gross income, is going towards your housing costs. So this is your mortgage, your property taxes, and your property insurance. That means that you're paying $1,650 a month for your mortgage, property taxes, and insurance. And let's assume that you're putting 10% of your gross income towards your savings and 10% of your gross income towards your investments. So this is a little bit less than what I recommend, but let's go with that for the sake of this example. That's another $1,000 going towards your savings and investments. And of course, you have to pay income taxes on this $5,000 because the IRS wants their cut. And if you're making $5,000 a month, that's $1,100 a month going towards your income taxes, assuming that you're not in a super high tax state like California or New York. If you spend this money on your income taxes, on your savings and investing, and then this much is going towards your housing costs, that's gonna leave you with $1,250 a month to spend on your car insurance, your car repairs, your gas, your heating, your AC, your groceries, your medical bills, your vacations, your birthdays, and everything else. The majority of Americans are living paycheck to paycheck because of how high their housing bill is. That means you don't have this $1,000 going towards your savings and investments, and you can replace that with your credit card bills and your student loan bills. So you don't have no money going to your savings and investments, you have more money going to all of your bills, and you have nothing left over for yourself because you're spending way too much money on your housing payments because that's what everybody thinks is normal. Now what I want you to do is stop thinking like the majority of people, because we're the minority mindset, and start thinking like the minority of people. What I want you to do to be able to afford your mortgage payment is have your mortgage payment be no more than a quarter of your total take-home pay. So if you're taking home $5,000, then your mortgage payment should not be more than a quarter of that. So you got to factor in taxes, and based off of what you keep, then your mortgage payment should not be more than 25% of your total take-home pay. If you already own a home and you feel like your mortgage payments are stretching you too thin, then you might want to consider refinancing your mortgage, because that can be a way for you to save money on your monthly mortgage payments. Fourth, you should not be buying your home as a way to get rich. Many people have this misconception that your home is an investment. Your home is a place where you live in. It can make you money. Many people have made a ton of money by owning a home that had appreciated in value, but you should not treat your home as an investment, because if you really want to get rich and you want to do that by investing your money, you can get a much better return on your money by investing your money into an investment property instead of the home that you live in. Everybody sells the idea that the home that you live in is the best investment that you can make, because that's what makes banks money, that's what makes real estate agents money, that's what makes title companies money, and that's what helps fuel the government, because real estate is the backbone of America. So if more people are buying homes because they think it's the best investment ever, then the whole economy continues to function. However, Your home is a place where you live. It is different than an investment. An investment, especially when we're talking about real estate, comes with different tax breaks, it comes with different types of income, and it comes with different benefits. The home that you live in is something that you use. Now, this is something that can make you a lot of money. If you bought your home for $250,000 and it appreciates in value over the time that you live there, and you sell it for $750,000, well, you just made $500,000 in profit. However, you don't want to buy a home with the goal of trying to get rich off of it. This is where you can get into a trap of buying a home for the wrong reasons. Are you buying a home to get rich, or are you buying a home for a place to live? Because if you buy a home with the idea that you're going to get rich off of it, it's much easier to get you to buy a home that you can't afford, with a down payment that you can't afford, with a monthly payment that you can't afford. Now, you're living in this big home, and it looks nice, it looks good on Instagram, your friends like it, but you're stretching yourself way too thin financially, and now if anything happens to the economy, or if anything happens to you financially, now you're underwater on a home that you thought was gonna make you rich. Treat your home like a liability. If it makes you a lot of money, great, but you're not buying it to get rich. If you want to get rich, you should be buying an investment property, because now you're buying this property for the purpose of making money, and during the time that you own this property, you're also making income every single month through rent. Buy a home with the goal of living there, not to get rich. If you want to get rich, then invest your money instead. And number 5, you should not buy a home unless you're ready to be a homeowner. Buying a home is a big deal. You shouldn't just buy a home because your mom and dad and uncle and aunt keep saying that you should buy a home instead of just throwing all your money in rent. You need to buy a home when you're ready to buy a home. It's not always cheaper to buy a home than rent a home, especially when you factor in property taxes and insurance and maintenance costs and the opportunity cost of what you can do with the down payment. Buying a home is cool because now you can put it on Instagram and show everybody that you're finally a homeowner, but it also means you got to settle down. Are you ready to settle down in a particular location? Buying and selling a home can be expensive, and it can take a long time. So if you buy a home and then you realize you weren't ready and now you want to sell the home, it could take you 2, 3, 4, 5, 6 months to actually sell the home and find a good buyer. That means your equity and your money in your home could be tied up for a long time as you're looking to sell your home, and if you have to move quickly, that could slow you down. I'm not trying to discourage you from being a homeowner. Homeownership is great, but you just got to make sure you're ready to be a homeowner. Can you afford it? Can you afford the down payment? Can you afford the monthly payment? And are you ready to settle down? If you are not ready to be a homeowner, don't go and buy a home just because everybody else is doing it. You are going to regret that decision later. Instead, rent a home, figure out where you like to live, figure out your money situation, and once you're ready to buy a home, now you can go out and find the dream home that you want and actually be able to afford it. Between 1913 and now, $1 has lost just over 96% of its buying power, and between 1971 and now, our dollars have lost right around 85% of their purchasing power. That means that $1 in today's time has the same buying power as 4 cents back in 1913, and $1 in today's time has the same buying power as 15 cents back in 1971. This trend is bad news for savers because your savings aren't growing. Your savings just sit there, they stay flat while the price of everything else around you keeps getting more expensive, but it's good news for investors and the financially educated who own the assets, because as dollars become more and more diluted, asset prices keep going up. We are in a very low interest rate environment right now, which means if you put your money in the bank, if you take $1,000 and you put it in the bank, after 1 year, you're gonna have $1,000. Back in the day, if you put $1,000 in the bank, you might be able to get a 2% return on your money, or a 5% return on your money, maybe even a 10% return on your money, depending on how far back in time you go. But nowadays, we are in an environment where banks pay you nothing. When you deposit your cash in the bank is gonna take this cash, they're gonna lend it out to somebody else, and they're gonna charge 3, 4, 5, maybe 15% a year in interest, depending on what kind of loans they make, whether it's a mortgage or a credit card. So the bank is making money off of your deposits, and in return, they pay you nothing. The majority of people assume that keeping your money in the bank is a safe investment, because when you keep your cash in the bank, it's protected. It's safe. You have $1,000 in the bank today, and if you go there tomorrow, you know that you're gonna have $1,000. And even if something really bad happened, you're protected with FDIC, which insures your investments, your bank deposits up to $250,000. So even if something happened to the bank, your money is still safe. You still have the cash that you can access. The only problem with that is a lot of times these safe investments end up being the most risky investments. Because yeah, if you put $1,000 in the bank today, you'll be able to access this $1,000 tomorrow or a year from now. The only problem is that $1,000 investment or saving, whatever you want to call it, in the bank is a guaranteed losing investment, because every single day that money sits in your bank account, it's losing buying power and it's losing value thanks to inflation, because you have $1,000 in the bank, but things that cost $1,000 today are not going to cost $1,000 in a year, and they're not going to cost $1,000 in 5 years or 10 years. They're going to get more and more expensive, while the $1,000 that you have in the bank is just going to sit there and stay at $1,000. I grew up in a saving heavy household. My parents are immigrants from a state in India called Punjab, and people who come from the traditional Indian culture have this save first mindset. And so my parents always told me that if I wanted to become successful, I had to study hard in school, become a doctor, and when I became a doctor, I'd make a big salary, which meant I could save a whole lot of money. So the whole plan that I had before I started learning about financial education was make a big salary and then save as much money as possible. The problem with that is your savings are losing investments. You can never become wealthy by saving your money, because your savings are guaranteed to lose value. Cash is a liability in an inflationary environment, because your cash sits there flat while the price of everything else keeps going up. One of the reasons we saw such a big drop in the value of our dollars after 1971 was because in 1971, President Richard Nixon took the United States dollar off of the gold standard. Prior to 1971, the value that each dollar had depended on how much gold we had as a country. But then the United States government started running into some economic issues, so that's when President Richard Nixon took the dollar off of the gold standard, so they stopped the connection between gold and the dollar essentially just became pieces of paper that now the government, with the help of the Federal Reserve Bank, could print on demand. This is great news for the wealthy and the financially educated, because now all these new dollars were being printed and entering our economic circulation. And where does this money go? Well, you can kind of think of it like a stimulus check. Let's just assume that a whole bunch of people get a brand new $1,000 check in the mail. What are they going to do? Most people are not going to save it and invest the money. Most people are going to take this money and they're going to go out and they're going to go shopping. So now when they go shopping, now the business owners make money and the investors make money, because the businesses make bigger profits, and when the businesses make bigger profits, so do the investors. So as more and more money gets printed, this money flows to the top, which makes the rich richer and it makes the poor poorer, because now the poor might have a smaller amount of dollars, but even if they had the same amount of dollars as before, the amount of dollars relative to all the dollars out there are smaller, which means each dollar is worth less. So even if you have the same amount of dollars as before, each dollar doesn't have as much buying power, so you're effectively poorer than before because of all this inflation. That's why inflation is known as the hidden tax, because it makes the people who are unaware poorer without you even knowing about it. Ever since 1971, the United States government has been working with the Federal Reserve Bank to print money and inject this money into the economy to help the economy grow quicker. Now, this works as long as people are happy working for this kind of paper money, fake money. But if people ever realize that, hey, we're not happy working for this fake money, we want real money, that's when you run into issues. This is the same issue that has caused so many empires to collapse in history. The Roman Empire, the Weimar Republic. You saw the same thing happen in Venezuela in 2017 and 2018. If people are not happy with the paper dollars that they're receiving and they want real money, then that's when you run into economic crisis. Now, the topic for today's video is not hyperinflation or the long-term effect of money printing. It's understanding the importance of saving your money and saving your money the right way, the smart way, instead of being the person that's just saving your money hoping that your savings are going to become wealthy. Because one of the biggest lies that are told to people is that you can save your way to wealth. Saving your way to wealth is kind of like taking an escalator to go up a flight of stairs, except the escalator is not going up, it's going down. So now you have to fight the escalator to go up. Not only do you have to go upstairs, but now you have to fight the current of the escalator to go up the stairs. I save money for only 3 purposes. I do not save money hoping that my savings are gonna make me wealthy. I have a reason for why I save money, and it has to fit into one of these 3 reasons. The first reason why I save money is to save money for emergencies. I look at my savings kind of like a cushion to protect me from an emergency. If my car breaks down, if something happens to my house, if something happens to my my wife, then I want to have some cash that I can fall back on. That way I know that, hey, I don't got to worry about ever going into debt. I have this cash sitting there so I can take care of whatever emergency might come my way. You want to have somewhere between 3 and 12 months worth of expenses sitting in a savings account that is liquid, that you can access anytime, because now this is money that you have that you don't have to worry about going into debt for. This is cash that you have for an emergency. But after you have this emergency savings account filled, again, somewhere between 3 to 12 months worth of expenses, depending on your risk tolerance. If you're okay taking on more risks, then maybe around 3 months worth of expenses. If you don't like risk, then somewhere around 12 months worth of expenses. But you want to take this cash, put it in a savings account, put it in an account somewhere that you can easily access. And once you hit your savings goal, you don't want to save any more money in this account unless your expenses really go up. But unless your expenses keep going up, you do not want to save more money into the savings account. You just want to let this cash sit there. So think of it kind of like a glass of water. Once you fill up the glass of water, your savings are full. You don't need to put any more water in your glass. And in this case, you don't need to put any more savings in your emergency account. So you need to have this emergency account to protect you from a financial emergency. This is not money that you're using to make you wealthy. This is not money that you're using to buy a TV when it goes on sale. This is not money that you're going to use for a down payment on your home. This is extra cash just sitting there to protect you against the worst case scenario type of situation. Second reason why I save cash is to save money for my purchases. So I use cash to obviously pay my bills, and then if I want to buy something, if I want to buy a car, if I want to buy a home, this is cash that I need to have aside. So I will save money for a big purchase or a smaller purchase. So I'll save cash or put aside cash, that way I have the money to do that. And the third reason why I save money is to make an investment. This is the biggest reason why I save cash, and this is money that I have in a bank account that I know is going to be invested. I don't want you to think that as soon as you have some extra cash, you have to invest it in the market today, or you have to use it to buy something today. You just need to understand that this is money that needs to be invested. So I have a separate bank account where my cash for my investments go, and this money sits there until a deal comes my way. Maybe I'm looking for a good stock deal. Maybe I'm looking for a business to buy. Maybe I'm looking for a real estate investment property, but this is the cash that I have there waiting to be invested. These are the only reasons why I save money, and this is how I save my money. You can notice that I don't have a reason here, number 4, saving, that I save my money for my future, can't even spell right now, wealth. I don't do this. This is what so many people that I know do, especially people in the Indian culture, because we're told that if you want to become wealthy, you just need to be a heavy saver. They cut back on their expenses. They don't spend money. They save as much money as possible because they think that, hey, this is the money that I can use to live off of when I'm older. That is one of the worst things that you can do, because this money is going to consistently keep losing value day after day after day after day because of the inflation that we're seeing. The cost of living keeps going up. Life is going to be way more expensive in 30 years than it is today. You do not want to be saving your money today, riding this escalator up when the escalator is going down, when you can put this money somewhere that is going to grow in value. This is what financial education is all about. What you want to be doing with the cash is really focusing here. How can you grow your money? That way you can become wealthy. How can you take your cash and put it somewhere that is going to grow with inflation? Because the reality is we're going to continue to see inflation. We're going to continue to see money printing happen. Back when the 2008 crash happened, we saw a historic amount of money being printed, and nobody could believe that the United States government could do a $1 trillion bailout package. Well, then 2020 happened, and we put that $1 trillion figure to shame because we printed so much more money during the 2020 pandemic and into 2021. And chances are when the next market crash happens, we're going to be printing even more money. So instead of being on the defensive and then getting upset anytime this happens, you need to start playing offense, and you need to start using your money as a tool. That way when all this money printing happens, you're not the one that's now having to deal with all these higher expenses. You're the one who owns the assets that now become more valuable because dollars keep losing their value. The way you invest your money is going to depend on your goals. Do you need cash flow now? Or are you okay investing in something and hoping that this thing is going to be worth a whole lot more money in 10 years or 20 years? So depending on your goals, your investment strategy is going to differ. I love cash flow. That's why I love investing in real estate. And anytime I talk about investing in real estate, you get a few different pieces of criticism. First, people say, oh, that's expensive, I can't do that. Or what happens if we see another housing market crash? I don't want to invest in real estate before the market crashes. And let's start with this. If you tell yourself that you can't invest in real estate because it's too expensive, I guarantee that you'll never be able to do it. But what you can do otherwise is you can tell yourself, all right, I want to invest in real estate. How can I do it? Now your brain's going to be working to help you figure out a way to invest in real estate, because there's a lot of different ways that you can invest in real estate that don't require a ton of cash out of your pocket. And even if you need more cash, then maybe you can start looking for other ways to earn some more money. That way you have more cash to use as a down payment to start investing in real estate. If you look in the Midwestern United States, there are a ton of neighborhoods where you can go out and buy a home for less than $150,000 that you can then turn around and rent for $1,500 a month. And these are growing neighborhoods where businesses are moving into, where people want to live. If that doesn't work for you, then you could go out and buy a duplex to live in yourself. So you live in one of the sides of the duplex and then you rent out the other side of the duplex. So you bought a home for yourself to live in, you're just renting out half of the home to somebody else. If that doesn't work for you, then you can go out and buy a home to live in yourself, and after 1 year, you can move out and let somebody else live in this property, and now they can pay you rent. And because you bought the home originally to live in yourself and you lived there for 1 year, because most banks will require you to live in the home for 1 year before you can rent it out to somebody else, you get to keep your lower interest rate, and now you have your first rental property. If you do it right, they'll be paying your mortgage, paying all your bills, and putting some money in your pocket every single month. And if that doesn't work for you, then you can buy a home to live in yourself, and you can rent out the basement, or you can rent out one of the rooms. There's always a way to find opportunity if your mind is open to the opportunity. If you shut yourself down and you become a cynic, you become a hater, where you always say, oh, I can't do that, only you can do that, or I don't have the ability to do that, I guarantee you will never have the opportunity to become successful, because you're going to shut down every opportunity that comes your way. You can also invest in the stock market. I have money in the stock market. I invest every single week into a few different ETFs. So now I'm getting exposure to the general market. An ETF is an exchange traded fund, and you can think of it kind of like investing in a basket full of stocks. So now instead of trying to find the perfect company to invest in, you can just invest in an ETF that gives you exposure to the entire stock market. So if the stock market goes up, your investment goes up. The stock market goes down, your investment will go down. This is an easy way for you to create a system where every week or every 2 weeks or every month, you're just going to invest a little bit of money into the market. The way for this to work and for this to build you wealth, you have to stay consistent. When the market goes up, you keep investing. When the market goes down, you keep investing. You do not want to stop this strategy, because what's been proven with this strategy time and time again is that if you want it to work, you have to stay consistent even when the market's up and even when the market's down. You can also look at investing in individual companies, whether it's on the stock market or outside of the stock market. You can invest in growth companies, startup companies that are looking to go public, that are looking to trade on the stock market or get bought out, or you can invest in individual companies on the stock market if you're willing to put in the time to research companies and analyze the numbers. This is another way that I like to invest my money. I don't get a return on my money very quickly, but I'm looking for long-term growth here by investing in companies that I believe in, that have a good product for the long term. There are so many different ways for you to invest your money, and now thanks to the internet, it has become more accessible than ever for anybody to start investing your money, because now you can invest your money on virtually any asset class for less than $100. The thing that you have to remember is that our dollars are now liabilities. Our cash is losing value, because as more and more money is printed, the value of each dollar that we have goes down. And you're going to see fluctuations in dollar value. Sometimes it'll go up, sometimes it'll go down, but over the long term, we've seen the dollar lose 96% of its value from 1913 until now, and we saw the dollar lose 85% of its value between 1971 and now. And you can expect that over the next few decades, you're going to continue to see that trend continue downwards. So as the dollar loses value, you need to own the assets that will appreciate in value as the dollar keeps going down. This is what financial education is all about. Let's talk about how you can start saving money, or how you can save more money quickly. If you've been watching our videos, you're probably a little bit confused, because I keep talking about how saving your money will make you broke, because your money in the bank is losing value to inflation every single day. I'll link a video in the description so you know what I'm talking about. Yes, that is still 100% true, which is why we're not going to be saving all of our money. The only reason you should be saving money is saving your money so you can invest it later on, or saving your money for emergencies, because if your AC stops working in the middle of the summer, you don't want this little crisis to turn into a life crisis. Your savings are not there to make you richer, unlike what the majority of people say. Think of your savings kind of like a shield. It's there to protect you. It's there to protect you from freaking out when you get an unexpected bill, and it's there to protect you from going into debt when life happens. Hey, where did my money shield go? If you don't know how much to save, start by saving a minimum of $2,000 with the goal of saving 6 months worth of your expenses. There are 2 ways to save money. You can earn more money or you can spend less money. You need to be doing both of these things, but in this video, we're going to be going over 4 ways you can save by spending less money. I know it's not as fun as earning more money, but the things that we're going to be talking about are super important. This way, when you earn a lot more money, you'll understand how to be financially smart. First, and I want you to do this first, take out a piece of paper and a pen or open up an Excel spreadsheet and write down how much money you're bringing home every single month, and below that, write down all of your expenses. Don't skip this step. I know you've heard me say this before. Pull out your bank statements and pull out your credit card statements and write down every single one of your expenses. If you don't know where your money is going, you won't be able to optimize it and manage it better. Where's all my money going? I know it hurts, but the first thing that's gonna happen is you're gonna find expenses that you didn't know that you had. When did I sign up for a monthly subscription to Unicorn Lovers? I've been paying this for 3 years? Then the second thing that's gonna happen is you're gonna see where you're overpaying, which brings me to the second step. We're gonna go minimalist, sort of. You need to save $2,000 as fast as possible so you have a cushion to protect you from life's wild adventures. So until you have $2,000 saved up, you got to become very cheap. Hey George, I don't think I can come with you to the Gucci store anymore. Justpreet's yelling at me again. Cut out everything that you do not need to survive. And I mean need to live day to day until you have those $2,000 saved up. Wait, but what about my Netflix subscription? How am I gonna find out what happens in Stranger Things? As much as it hurts, turn off Netflix and everything else that you don't need to survive and sell the things that you are not using until you have those $2,000 saved up.
Oh, I hate you so much, Justpreet.
You hate me now, but you will thank me later. You have to put in this intense sacrifice in the beginning until you have $2,000 saved. Hey, do you hear that? You know what time it is? It's money management time. Once you do have those $2,000 saved up, then you can put in more emphasis and effort on growing your money through things like investing. Third, now take all the bills that you have left from the expense sheet that we did in the first step and stop paying these people so much. Call up all of your service providers like your cable and your internet and your cell phone and negotiate your bills lower. I just read an article on Consumer Affairs that said that 95% of consumers are overpaying for at least one bill because we're too scared to negotiate down these hidden fees. It's funny, back in Punjab, India, where my family's from, people negotiate the price of literally everything. If you want to go and buy grapes and tomatoes, well, you're going to be negotiating the price of that. 45 cents a mango, the guy across the street said he can do it for 42 cents. Can you beat that price? What I learned from negotiating in India is the worst thing that can happen is they say no to you. You will be surprised at how easy it is to negotiate some of your bills lower if you just ask them nicely. I already made a video where I go over how you can do this step by step, and I'll link it in the description below. A 15-minute phone call with your customer service representative can save you 10 to 20% on your bills every single month, and you got nothing to lose. I feel like I should include that Geico commercial here where, you know, the guy in the really deep voice goes, 15 minutes can save you 10% or more, but you have to pick up your phone and ask them. Fourth, if you didn't like me when I told you to turn off your Netflix, you're really not gonna like me now. Stop having expensive fun for a little while. Who wants to go shopping? Wait, I can't do that anymore, can I? CNBC reported in 2018 that people are spending an average of $450 a month on impulse purchases for things that we don't need. Oh my god, this frying pan is only $19.99. What would Justpreet say? We are going to be cheap for a little while. I know it's not fun, but you have to do this for your finances. You have to have a minimum of $2,000 saved up for emergencies. So make a list of things that you need before you go shopping and don't buy anything that's not on the list. Wait, but what if? Nope, can't have it. No, but there's a huge sale. Did I stutter? No. Look, until you have $2,000 saved up, no shopping and no spending unless you need it to survive. Now, I want to make sure that I say this and I want to make sure that this is clear. There is absolutely nothing wrong with buying nice and expensive things or having fun with your money if you can afford it. If you want to go drive around in fancy cars and fly first class and do all of that, great. Just make sure you have the money to do it and that you're not going into debt to do these things. Controlling your spending is the first step to building wealth and understanding money, because now if you go out and you earn a whole bunch of money, you don't have to worry about all of it disappearing because you understand how to manage it. Could you imagine what would happen if banks were honest? Where if you walked into a bank to get a loan and the bank manager said, you know what, yeah, I can approve you for this loan, but I don't know if you want to do this, because if you take out this loan from me, then you're never going to become wealthy because you're spending all your money on things that you don't need. You sure you still want that loan? If banks were honest with you, people would not be taking out all these loans to